Okay, well, thank you for joining us for the repo panel. In this panel, we're going to look at the repo market in transition, resilience, clearing, and the road ahead. To do this, I'm joined by a group of market experts that cover different areas, sell side, buy side, and infrastructure. I'm joined by Amanda Butavand, Managing Director, Head of Financing Sales, Crédit Agricole. Thomas Hansen, Global Head of Securities Finance, Banco Santander. Janina Marks, Head of Sales and Business Development, Derivatives and Clearing, Euronext. Olivier Nin, Head of Product and Head of First Line Risk, LSEG, RepoClear. And Tom Williams, Head of Solutions Trading and Structuring at Schroder's IM. Now, I'm going to steal an analogy from Thomas. He said I could do it, so I hope it's okay. When we think about how the repo market is evolving, and perhaps thinking about bond markets more in general, and particularly when we think of the previous panel, it's a bit like changing your car from a combustion engine to an EV. It's not just a case of trading in your old car and buying a new car. You have to think about the entire infrastructure. The infrastructure has to be there to support it. I'm hoping we can use that analogy as a framework. And the way I'm thinking of approaching this discussion is to start with maybe we could look a little bit at the macro, particularly in light of some of the things that were said earlier today. We can then start looking at market structure, delve a little deeper into the plumbing, and then maybe look towards the future. So starting with the macro, I mean, right now, it seems as if the repo market is the center of everything, particularly when we have discussions around sovereign bond market resilience, financial stability. Those of you who heard Sarah Breeden this morning, she talked about the repo market being the most important segment of the government bond market. Samara Cohen talked about repo as being the most important pressure valve in times of stress. So why is this? Why is repo getting so much attention in this discussion? Maybe we could start with Amanda and Thomas.
Okay, so I think, yes, from a sell-side perspective, I can really say that the repo market is central. It is the transmission mechanism between liquidity, collateral balance sheet, monetary policy. If you look at all recent major market developments, they ultimately all feed through repo. Sovereign issuance, leverage constraint, collateral optimization, even settlement efficiency was hit with T+1 currently. So it's not just a funding tool anymore, it's really an important piece of the whole market infrastructure. In Europe, it's even truer because the market is heavily collateralized and heavily bank intermediated. So when the repo market is functioning smoothly, all markets absorb shocks more gradually. If you have some tightening in the capacity of intermediation, then the consequences on other markets than repo will be price dispersion, some lack of elasticity in the market, the bonds becoming special. So this is where it's important to notice that the collateral is not the issue, and the challenge is really to maintain this intermediation capacity, and it's linked to the constraint that we have on scarce resource. So yeah, to conclude on that topic, I would say that the repo is the link. It connects the real economy, the market liquidity, the sovereign funding, and the financial stability all at once.
Thomas, do you want to build on that?
So go back to the analogy we were talking about. For me, the repo market is the electrical grid of the whole system. the different functions in a financialized economy, the different activities that take place, for me, are the different vehicles that need to use the grid and need to charge. So if we only have lamppost charging for charging electrical vehicles, which are big trucks, we're going to have a problem. If we cannot transmit it along the grid to the right places at the right times, we will get overheating, we will get blackouts. Today we are, and the reason why the repo market is in focus, I would arrogantly say the repo market was always the most important part because it's the bedrock of everything. But today we see it because in this financialized economy that we have financialized over the last 30, 40, 50 years, we now have a number of exogenous shocks that Amanda was talking about, and you can make any list of them, but they are putting pressure into the system in different places. We have a highly leveraged government debt sector that needs support. That happens via the repo market. We have a lot of collateral transformation, and then of course the transmission of monetary policy in certain regions are conducted more with collateralized lending than in others. So, like Amanda says, there are some acute specific things today, and some people will think that some are more important than others. We've also laden ourselves with a lot of regulatory changes over the last 10 years or maybe even longer. At the moment, we are going through my pet hate one, which is the T+1, because it takes a lot of my time. So all these changes means that it is very, very important to focus on the resiliency of that system, because we are not necessarily stressing it, but we are testing it at the seams and in certain sections. And they are more interconnected than we think they are. And it's all about the velocity of money, but in the repo market, it's the velocity of the collateral that we need to ensure does not meet choke points and therefore slow down.
It's an interesting point, particularly the velocity of collateral and the velocity of money, which seems to be speeding up. And I think most of us, or certainly I tend to think of that from a bank perspective. But how important is the repo market from a buy-side perspective, Tom?
Well, it's obviously vital for the buy side. And that goes beyond the fact it gives us an ability to safely invest overnight cash. I mean, that is the starting place, but actually the repo market, in the way that we manage money, goes much beyond that. For me, the two main areas I'd highlight are one, where we use repo, as you said earlier, as a pressure valve. Often when we're using derivatives to hedge other risks that our clients are taking on, such as currency risks, credit risks, perhaps other interest rate risks that they want to no longer to be exposed to, we have to be able to hold collateral, and we use repo to transform the assets they want to hold into the assets they need to hold, such as cash, to be able to post and make margin calls. But if we move beyond focusing on safety, we also then move into the other major usage of repo, which is becoming even more important, which is repo as a way of accessing leverage. Now, I, for one, sometimes get frustrated when leverage is treated as a dirty word in the market. Leverage actually is something that allows you to make your money work harder, make your capital stretch further. It allows you to take one pool of capital and achieve multiple goals at the same time. We use leverage in a number of our portfolios, and we use it and try to be using repo to enable that in a way that gives us a well-thought-through portfolio that meets our end clients' needs. But within that, as you alluded to, there's an increased pressure on that leverage and on that repo usage through those large government deficits that we're seeing throughout the developed world. And I think that's important for us to think about as we think about the next wave of repo regulation and the repo plumbing, is how can we have a situation where government bond markets, which have relied on leveraged investors for many years to actually take down the supply the governments need to issue to meet their political goals, how can we make sure that the plumbing is ready to handle the stresses that will inevitably come? Now, some efforts so far have been, I think, really well received by the market, such as the Bank of England's new contingent non-bank repo facility, recently now fully operational. That's great because you're creating what is effectively a pressure valve for the pressure valve. But to allude to the earlier keynote speech that we heard about, I think there are a challenge we need to face about creating a type of regulation that is a permanent, always-on impediment to market functioning, when actually what we're trying to solve for is a stressed market pressure valve and solutions to that sort of market scenario.
It's interesting you mentioned leverage has become a bit of a dirty word, and most of the concerns around the repo market and its role in market resilience relates to the buy side. It's the NBFIs, it's the leveraged community in particular, and their footprint in the sovereign bond market. It raises a question. I mean, who are the liquidity providers in the repo market? Is it the banks? Is it somebody else? I don't know who wants to take this.
So I would, from a sell-side perspective, I would say that banks are still very core liquidity provider, but the market has evolved and is broader and more fragmented. So we have an hybrid structure where on one side you still have the banks who provide the balance sheet intermediation, the access to central bank facilities, the collateral transformation opportunities. But on the other side, you have the hedge funds and the wider NBFI community that increasingly drive the flow, the relative value opportunities, and the market depth, to be honest. So it's this ecosystem has to function some way or another, not just under normal condition, but under stressful condition when the capacity from bank to deploy this intermediation might be reduced. So the pressure now is on, I would say, on both sides.
So that's interesting. So the microstructure, or certainly the weighting in the microstructure, is changing a lot. I'm bringing this back to Thomas's analogy as well. The actual structure, the grid has to change as well, right? And where do CCPs come into this? I know, Janina, if I want to start with you.
Sure. So as CCPs, we're obviously part of the plumbing and the infrastructure. I think when we talk about repo clearing in particular, the focus is a lot about liquidity, it's a lot about collateral mobility, and it's a lot about access. And I think on access, we are definitely seeing a broader participation in terms of who we're talking to. So banks and DMOs being sort of some of the clients, hedge funds, asset managers and pension funds. We are talking to all of those different types of counterparties about clearing. And I think, interestingly, they all have, as you'd perhaps expect, different requirements. And that is requiring us as plumbing to be flexible in terms of the solutions that we put forward and in terms of how we meet those requirements. So I think from a Euronext perspective, you know, we have been looking at how we can provide buy-side access. We have, you know, a model live today that is a sort of GCM structure that doesn't meet everyone's requirements. And as a result, we've invested in sponsored access and two types of sponsored access. So I'd say that flexibility is key to ensure that we look at the clients and the different requirements that they have, and we provide solutions to them to make sure that the overall system remains resilient, it's robust, and is ultimately, as a CCP, you know, has the appropriate risk framework around it.
Thank you. Olivier, would you like to build on that?
Yeah, but I mean, I tend to agree, of course, with my co-panelists, and I would say that, I mean, for many years, CCP has been very much, at least on the repo market, a dealer-to-dealer segment. It has to change because the market is evolving. I mean, we all know that there is much more buy-side now, which is involved in the primary and secondary market on EGBs and the repo market as well. And therefore, I mean, we have to provide this solution. I mean, this is why, I mean, for many years now, I mean, we are working not alone, but of course with the market to be able to design a solution which is fit for purpose. Are we there yet? Probably we still have to make some evolution, regulation as well, but this is definitely the direction of travel, and this is what we have to do, because if the repo market is definitely the market which is at the center of funding, collateral, leverage, monetary policy, but which is a kind of a situation which can avoid a crisis if it's worked properly, CCP has a kind of shock absorbers as well. So we need to make sure that CCP are able to perform that role, even in time of stress, which is exactly when you hope this market, at this infrastructure, to perform well. We cannot not working on that day.
Okay, I want to explore this a little bit more. I don't think it's that quite black and white, but we're gonna dig into that a little bit. But I mean, the point you made about dealer-to-dealer clearing, I mean, we were doing that when I was trading, so it's been around forever. But dealer-to-client clearing hasn't really, at least in Europe, and we can maybe reflect on the US in a moment, at least in Europe, it hasn't really taken off. Tom, why is that?
I think hasn't really taken off is a kind way of putting it. I mean, repo clearing has been available as an option for nearly a decade in the UK market, and clearly has not found a form which has attracted clients to it. Now, for me as a money manager, when I think about that, I break it down to 3 pillars. One, access and the cost of that. If you imagine certainly the repo market as you see it in the UK, certainly from the cash borrowing side of things, it's scores and scores and scores of small and mid-sized pension schemes, all that would have to set up clearing agreements, clearing brokers, have educational sessions for their trustees to understand what this new product is. And they would need some commercial reason to want to do that. Simply put, the liquidity and cost in terms of price benefits repo clearing have not been there, and that has impeded its adoption. It is not cheaper to trade cleared repo, and you don't get access to more liquidity, certainly in sterling. Alongside that, actually, ironically, and the very same issue was actually covered in swaps clearing for a number of years ahead of this, which is why pension schemes are now permanently exempt from swaps clearing, is aspects of central clearing can actually be quite dangerous. In particular, T0 cash margining, logistically, for a lot of pension schemes, which at times can be quite slow moving, is simply too rapid, often, to be able to react in stress scenarios. Some of the most problematic derivative positions during the 2022 crisis were actually not repos, they were cleared swaps, where cash margin was immediately required. That often became difficult to deal with in stressed markets, especially when it still costs a large set of clients and in a short span of time. If we can solve some of those issues around margining and access, perhaps it would be easier and safer to access the cleared repo solution. But I would also hope that we'd have a commercial incentive in some way of it being cheaper and deeper than it currently is.
I think the commercial incentive side is important, and I'm sure Janina and Olivier will have some views on that. But just taking a step back, I mean, there's an easy way, right? The US found it. You just mandate clearing. Thomas, how do you feel about that?
So clearing for me is a paradox, because theoretically it gets presented to us that it makes the world safer. It does if we force everybody to be exactly the same and we all insure ourselves to death. Now, the analogy to the EV, to go back to that one, is that if we make the grid the same for everybody, there is no choice. You could mandate it, which means that there is no choice. You have to do it. But it will not serve everybody equally well, because if you are that big truck that needs to charge at a lamppost with 21 kilowatts, you're going to have a problem. We have the same problems today. There are certain products where the CCP, in my view, does not offer a better solution. We haven't solved for what happens to maturity transformations. In the CCP, they are super expensive. Mm-hmm. A lot of the maturity transformation happens by people taking on that risk with a counterparty. And under the current capital regime, they have to post a certain amount of capital to the side for that position. So from a risk perspective, you could discuss, is that better? If it worse, of course, if you pay more margin, the system itself is safer, but if it's too costly, the maturity transformation will not happen to the detriment of the real economy. There are other situations where this is the same. There are certain counterparties that provide cash to the market that if they went through the CCP, then we couldn't see who they were. We could not treat that cash the same way in the liquidity regime as we otherwise would, because some liquidity has more value, even though it's short term, but from certain counterparts. So for me, there is a paradox here that the CCPs does have a place, because there's a certain segment of the market where a certain type of plumbing is needed, but you don't need a grid for a London central borough in a small village somewhere else. That's the analogy for me. So I think we have to be careful and just say, hey, in the US they did it, so why not? Because I think in the US, there's a number of factors that made it a lot easier. One country, one central bank, one currency, and one issuer. In Europe, a lot different. So there's a lot of fragmentation, whether we like to use that word or not. There's a lot of CCPs as well. So what would you actually achieve with it? Well, it's true that if, from a commercial perspective, if we made other alternatives to CCPs expensive enough, we will take the cheapest option, and then Tom will be knocking at the door. So for me, it's a very paradoxical discussion, because on one hand, it makes sense, and then you turn it around, and then it doesn't at all. But it does mean that the CCP certainly has a place, because one of the reasons why the dealers came together and wanted to deal in the CCP was to save capital when they traded with each other. And we're having in the T+1 discussions a lot about, oh, now everything needs to happen very quick, so we not have some big pauses, a few pauses and net transactions before we send them to settlement, which in essence is kind of what the CCP does at one point in time as well, right? It's they net things off from us, not just from a credit perspective, but easily also from a settlement perspective, that I don't have to settle as many transactions. So I think it's a much more nuanced discussion of whether or not it's good or bad. It is, where does it have its place and where does it not? And when you come to leverage, the paradox here is that if for a specific amount of capital, you now go into a CCP with multiple products and you allow cross-product netting, you need less capital to do the same amount of trading, which means with the same amount of capital, you can do more leverage. I don't know how to square that one.
No, it's an interesting one. And I think, I mean, if we look at what's happening in the US with the regulatory changes to support the mandate, we're seeing cross-product margining, and we're heading towards cross-product netting for capital relief. But this comes back to you guys, Janina and Olivier. I mean, what do you need to make this? I guess you're not looking for a mandate either. Or maybe you are, but you're not going to admit to it. What needs to be done to make clearing more commercially viable and interesting for your potential clients?
Yeah, I mean, I think that there's, it needs to be a lot of partnership amongst the industry as a whole. I talked about earlier about the different client requirements. I think we are on a journey. When it comes to cross-margining, I think that is a topic that lots of people talk about. And I think when we look at repo, we look at it as part of a broader fixed income asset set, so with fixed income derivatives and with cash bonds. And today, when we look at repo, we do have sort of some ability to cross-margin cash and repo to make it more commercially efficient. I think when you look at the capital requirements, I think it's really important that when regulators are looking at the repo market and at clearing, that it's not just a mandate that's looked at, that it's looked at more broadly in terms of the regulatory capital requirements to ensure that there are no disincentives or unintended consequences that directly impact clearing.
No, I mean, I agree as well. I mean, I would even maybe go further and say that we collectively, as it has been done in the US, by the way, we collectively need to look at what are the consequences and what are the impediments from a regulatory point of view to try to see if we can fix that. Because some of the regulatory elements have been done on purpose by the regulators, and maybe they want to keep it, fine. But some of them are just because at the time they've written the regulation, buy-side access to the repo clearing was not on the table at all. And therefore, I mean, we just have to go through that regulation and say, okay, well, this is what you written at the time. Is it on purpose, or is it just because you haven't thought about, and we haven't as well, so we haven't thought about the fact that he could be interested. So many things has been done for the bank to recognize the fact that a clear transaction is not exactly the same as a non-clear transaction, and so many little has been done for NBFI that, I mean, we need to look at all of that and potentially, I mean, harmonize to make sure that the proper incentive are provided as well to NBFI.
Okay, so essentially, I mean, there'll always be a cost, but the cost should be reflective of the true risk.
Exactly.
Amanda, what's your view from a sell side? I
think the question is not whether non-banks find value in the CCP. They clearly do. If it's not, the question is not this. It's whether the economics and the operational as well, operational framework are significantly aligned to support broader acceptation. I was in the room, in the speaker room, talking to someone who was going out, who was working on the buy side, and asked me what I will discuss on that. And I mentioned the clearing, and they said, it's easy. It just needs to be cheaper and less margin because the trades don't make sense. There is a point, and this is what you were saying, Thomas, as well, and Tom, the trades will not make sense if the margin fluctuates in terms of stress. And so if we want to come back, to circle back to your first question, if we want this second question on the liquidity provision, if we want the liquidity to still be provided as well, we don't want to have a hedge fund, for example, stepping out because it becomes too expensive, stepping out of the trade and just moving to another asset class. So it's finding that fine line, and when the buy side sees that it's economically efficient, operationally seamless, and the regulatory treatment is in line with bilateral, then you will be on a level playing field, whether at the moment there are still, I think, worries about the alternative bilateral trading being easier, because that's what people know.
Picking up on a point Thomas made earlier, couldn't you incentivize it by just making bilateral more expensive? I mean, haircuts comes up a lot. How do we feel about?
I mean, I think we need to recognise that if the cost of government issuance is predicated on levered investors buying it, if we, through haircuts, mandatory clearing, X, Y, Z, other route means, increase or impede the cost of leverage, there is a pass-through to government's debt costs from those actions that might outweigh the benefits of the stress scenario pressure reduction that those measures were intended to solve. This is not a free lunch. Now, within that, I think we need to think about levered investors, the buy side, pretty broad term, in two different categories. We have institutional investors, especially here in the UK, institutional investors such as pension schemes and insurance companies have actually de-levered quite a lot and have quite a stable leverage that is slowly but surely winding off. And what's often called fast money, hedge funds, where increasingly they are the marginal buyers of government debt, and increasingly they are the marginal consumers of a growing amount of leverage. We need to be thinking about those two in very different ways. Speaking with my pension scheme hat on, I could handle much higher haircuts. If I had to take one between mandatory clearing and higher haircuts, I would take higher haircuts any day of the week. They are too not a free lunch. My higher haircut to Amanda or Thomas is my higher uncollateralized risk to a bank. You know, them being protected from me makes me, you know, to a certain extent, at risk from them. And we're not in the too distant memory of certain large repo providing banks getting into quite a lot of distress. Not a free lunch. But if that is a means by which the system could be made at least safer, that's fine. But I think even with much higher haircuts mandated, I would not push into mandatory clearing voluntarily for my clients. Why? Because I don't think it is the safer option. It might be the better option for hedge funds, the fast money sector, if there's cross-margining, if there's other things that make it seamless, as Amanda was saying. But on my side of things, when I speak for a broad swathe of institutional clients, those issues around T0 margining in cash, the lack of maturity transformation. Why is the UK different than the US? Why is the Eurozone different than both of them still? The US is an overnight to overnight market between borrower and lender. That's not the case in these other markets. Without that maturity transformation, the netting benefits, the balance sheet benefits at the clearinghouse are simply not there for the banks. So what do you get instead? You get a lot of extra operational work, and you get a lot of extra stress risk around immediate cash margin calls. Without that issue being solved, I couldn't sober-mindedly move my clients towards clearing, even if it was operationally easy. Higher haircuts, I can handle. But that really, really gives me pause to think about how that would mean for the system, and in particular, what that would mean for the system in a stress event.
That's interesting. So, Janina, Olivier, it sounds as if some of Tom's clients wouldn't be suited for a CCP. Are there any particular clients that you are targeting, or types of clients that you think your models, sponsor models would be best suited for?
I mean, we are already live, for a couple of years already in both LCH and LCH Limited. We already have some clients using it, on a daily basis. So I guess, they are doing it because it fits their need. So, I'm thinking pension fund, I'm thinking insurance company. The project for hedge fund has been approved quite recently, and therefore, it's only on the market for quite a while, but people and banks and hedge fund are building it to be able to use it. So I'm guessing as well that, they are not doing it just for us. So I do think that we are already at a stage where our product, I'm not saying that they are fit for purpose for absolutely everyone and in all situations. This is not what I'm saying. But I do think that they, as Thomas was mentioning, they do have a place in the toolbox that some people should have to manage their liquidity, their collateral velocity, transformation, and so on and so forth. So we are already at a reasonable stage. We do agree that we still have some likely evolution to make, and this is why we need collaboratively to discuss and see, what is it that we need to improve, and the variation margin in cash is probably one of the key elements. We perfectly agree and aware of that, and we are keen to work on it, and that's something that we're going to keep improving, and hopefully, again, to make it fit for more and more people, but we never said, and we will probably never say, that it should be the only tools in your toolbox. That's part of the toolbox.
That's fair enough.
I agree. I think you've said it all. I think in terms of sort of all the different client types, the fact that you can't get access to cash margin calls, that's something that we as market infrastructure have to look at.
So we're going to start looking forward, a little bit still now. We're about to publish a paper kindly authored by Richard Komodo. Actually, it's going to be 2 papers because the first one was too long, on DLT repo. And there's a lot of buzz around tokenization in the repo space, but we also know it's happening. Is it a solution? And if so, what is it solving for? Who wants to take this? I'm looking at Thomas.
I thought we were going to talk about AI instead. I thought DLT was kind of in the past. DLT has a technical usage in my mind, is that it's a very clever way of doing databases and get away with a lot of reconciliation. That's what it is. It's a different mathematical way of solving a data problem. On the back of that, you have all the tokenization, digitizations, and so forth. There's been a lot of initiatives over the last 10 years. None of them have really been adopted. I am personally taking a little bit of a more dim view of that whole segment of the market because I think it needs to prove itself pretty fast for it to be usable for us. Because when we talk about plumbing, Europe, we have how many CCPs? 30-something? We have, 28 CSDs. Why are they not on one DLT, would be my first question. Why do we need all the different ones behind it? I can see the use cases one by one, but to Tom's point, it's been around for a long time. Where is it being adopted? I could see in a world where I think it would be very easy to demonstrate a use case would be with the transfer of collateral for margining, perhaps to the CCPs, that you can do that a lot faster. But other than that, I just don't, I'm getting skeptical because I haven't seen proof of this really being out there and being used by us. Maybe it's because our infrastructure is so old and it's, in this instance, it's not really EV, it's more like Thames water, right? It's leaking everywhere and it all needs to be changed, yeah? I don't know, but I'm a lot more skeptical than I was 12 months ago.
Anyone a bit more bullish?
I'm mid, so I might be a good transition, but I would say yes. In some area, it will be very helpful in terms of settlement efficiency, collateral mobility. We see a lot of friction today on that due to the fragmentation, but I really don't think that technology alone will be the solution, especially because the resilience, I think, of the market is the balance sheet capacity, your liquidity, it's the plumbing we were discussing. So the tokenization will help with these frictions, but I really don't think it will be revolutionary. It will be evolutionary, but an evolution, not a revolution. Really,
maybe I'm just impatient.
Because
super impatient about it because we go on DLT on that, but if it just means that a part of the settlement stuff that we do is that happens really fast, but then the rest of it is analog. So I still need to pre-position cash, so I still have to wait for cash to come in. When is it happening?
It might bring a better collateral management and more, like if you have real-time visibility, maybe some problems can be anticipated.
And I think this is the key point. I think we all feel around custodial settlement, just the basic plumbing of the system. There's a problem to solve. There's a felt pain that could be met. The real question will be, is this the right technology to go and do that? I think, is the question, is DLT, what is the problem that DLT could solve? I think it's more, how can we as an industry, going back to your very first point, solve the felt pain plumbing problems that we as repo market participants experience. I would love to see my bonds settle more efficiently. I would love to see partial settlements be easier. I would love to see custodial services be more easy and more transparent to monitor. Is blockchain or DLT the solution to that? I don't know. If it is, I'd welcome it wholeheartedly. But as would Thomas say, I've yet to see that transpire. So watching it, would love it to solve our lived problems, share a degree of skepticism.
Just thinking about the problem it could be solving for, and it's already been mentioned, maybe one of the challenges for buy sides entering clearing is T0 margin. I mean, this must be something you're thinking about. If you can tokenize and mobilize collateral in minutes, does this solve a potential problem?
Definitely, I mean, the tokenized collateral is one of the use cases that people are looking for, and we are too, because we have to. That's a point. But where I tend to agree as well on the difficulty of all of that DLT, collateral, tokenized, etc., is the fact that, as I think someone mentioned in a previous panel, if you look at what's going to be the world if everything is tokenized, everything is on one chain, I mean, to your point, I mean, to avoid the segregation, fragmentation that we already have in Europe, I mean, that's perfect. Today we are there, and the path in between where we are and where we could potentially be will be extremely painful, very costly since day one, for very little result on day one. So who today is going to accept to spend a lot of money on something that might become super great, but for very few results at the very beginning? I mean, that I think is a massive challenge.
Janina, is it something you're thinking about?
I mean, yeah, I think everyone's talking about tokenization and what you can do. I think the important things are going to be, are tokenized assets going to have the same legal and regulatory treatment as non-tokenized? Are they going to be interoperable across different networks? And also from the sort of common settlement element of it, what does that look like? Is it a stable coin? Is it a tokenized deposit? Is it something else? So I think there is definitely opportunities to look at removing friction and helping with speed of collateral, but there are certain things that have to be solved along the way.
So we're getting to the end of the panel. I just wanted to ask each of you just very, very quickly. I mean, we heard this morning that when it comes to regulation and policy to address some of the concerns about leverage and systemic risk and market stability, something has to be done. From your seat, if there was one thing that you think policymakers should do, what would it be? I'm going to start. Well, who wants to go first? Janina.
Okay, I would probably say look at the regulatory capital treatment of clearing to make sure that there are incentives for clearing on a voluntary basis.
For me, it will be a uniformization of all the regulatory obligations to be on a level playing field, because between the US, just between the US and Europe, you have such a difference in capital constraints that it doesn't make it easy.
I would welcome an increased and regular dialogue between the regulators and those they regulate. If you boil the repo market down, there's actually relatively few large participants. A greater understanding and transparency between those might actually give a lot of clarity on what would be the right solutions for the market and the right solutions for the system.
Two of you left. Thomas?
Leave us alone. No. If I could get them to do one thing, I think that they should set up a set of principles that when they come up with regulations that with the best intentions are there to make the system safer, make sure you do not reduce the velocity of money or collateral, because often that is the unintended consequence, and that is detrimental to the whole economy.
Yeah.
Olivier?
Yeah, and I mean, I agree with everything which has been said before, and I would add, I mean, be more flexible. I mean, the number of times where we come with a situation and we have an answer for 99.7% of the problem, but they just look at, but what if, and therefore we cannot improve the situation at all. So be more pragmatic, look at what would be good for the market most of the time, and that will already be an improvement.
Okay, lots of things we can pass on. Okay, well, we've hit our time, so please join me in thanking our excellent panelists.